Good afternoon, everyone. It's a Friday, April 22 in Manila. I'm John Garcia from PSE's Market Education Department, welcoming you back to PSE's Stock Market Webinar. Nako, na-miss namin kayong lahat. Na-miss nyo ba kami? Well, if you did miss us, please type yes in the comment section or in the chat box. So a lot has happened since we last streamed in December. We kicked off 2022 on a high note with the PSE Investment Expo. It is the biggest online investment conference where over 15,000 individuals registered and participated during the live 2 days and while the expo was available on demand for the entire month of February. So the expo would not have been a huge success without your active participation. So maraming salamat po sa lahat na nag-participate sa aming PSE Investment Expo. So our resource speakers then were very optimistic on the market. So kasi they were expecting that the economic recovery will be on full swing as the COVID-19 situation continues to improve. However, our local stock market had to take a step back due to geopolitical tensions which caused prices of commodities to rise. Particularly oil. Nako, ang taas na ng presyo ng gasolina, di ba? So the drop in the stock prices have prompted investors to sell and secure their cash while others waited in the sidelines. No, nag-wait and see muna. So yung iba naman, some saw this as an opportunity to look for bargains. Syempre naman, share price appreciation remains to be the primary way to make money in the stock market. And most investors are striving to buy low and sell high. As simple as it sounds, in reality, medyo mahirap siyang gawin. No? How can you really time the market? So especially with external factors continuously disrupting our market. So investing in dividend-paying stocks will help us or the investors to cushion the returns of our portfolio. Itong mga speed bumps na to, makakatulong sa atin yung mga dividend-paying stocks, which will help us grow our investment throughout the journey of investing in the stock market. So today, we invited a resource speaker from the Atram Group to give us a guide on how you can profit from dividend investing, the pros and cons of this investment strategy, and the common mistakes to avoid, and most importantly, the tips to consider when choosing a dividend stock. We also invited a colleague from the PSE Market Data Department to discuss the PSE's newest thematic indices and how these indices can be helpful for your investment strategies. But before we get started, here are a few reminders to our participants. Please remember that this presentation is for educational and informational purposes only. This should not be construed as a professional, financial, or investment advice or recommendation from the PSE. And as I have mentioned earlier, we have invited a guest from Atram to be our resource speaker today. Allow us to introduce him first before we go to his presentation. Our guest this afternoon is a senior portfolio manager and AVP at Atram. It is a company that manages portfolios consisting of mutual funds, trust assets, insurance portfolios, real estate for proprietary and third-party clients. He has 9 years of professional experience, having held similar roles at other capital market institutions like Metro Bank, FMIC, and Land Bank. He holds 2 master's degrees, one in management from the University of Asia in the Pacific, and another one is in computational finance from the De La Salle University. Ladies and gentlemen, help me welcome Mr. Carlos Roberto Navarro. Good afternoon, Carlos. Welcome to our webinar.
Yeah, good afternoon, John. Thanks for inviting me here. It's truly a pleasure.
Really, we are so glad to have you with us this afternoon. But before anything else, tell us more about what you do there at Atram.
Well, I can put it simply. I manage the equity portfolios in Atram. So this is right in my alley for the topic today. So yeah, I manage equity portfolios there.
Naku, mukhang we are really, we're really up for a treat. We're getting the tips and the lessons right from the expert himself, an equity portfolio manager from Atram. All right, Carlos, the floor is yours. Take it away.
Thank you. Okay, again, good afternoon, everyone. So thanks for tuning in. It's truly a pleasure to be here to give a seminar about dividend investing. So without further ado, we can now start. Yeah, next slide, please. So before we go into the more technical details, let's first go and have a definition of terms. So there are three types of dividends in the stock market. That's the cash dividend, the stock dividend, and the property dividend. So let's now go and define them one by one. So the first type of dividend is called the cash dividend. Now, what is a cash dividend? Well, as the name suggests, it's paid in cash for every share that you own. So an example of this, let's say you own Globe and Globe pays a 10 peso cash dividend. It simply means that you get 10 pesos for every single share that you own. So if you own 100 shares, you just multiply 10 pesos by 100 shares and you get 1,000 pesos. So that's the amount of money that you will receive in dividends. So that's what it means when it says that it's paid in cash per share. And this is the most common type of dividend because this is the most attractive kind of dividend for investors because I guess all of us naman, we want to receive cash. I think that's what's most important. So this is actually the most common type of dividends that companies declare. And this is usually a fixed amount or a percentage of the prior year's income of the company. So actually, I'll get more into detail regarding this later on because this is what we call the dividend policy. But I'll get into detail with that later on. But just to give you a surface point of view, it's usually a percentage of the previous year's prior income. And the next is dividend tax applies for your cash dividend, and the dividend tax is 10%. So for the example a while ago, you received 1,000 pesos in cash dividends, you pay 100 pesos or 10% of that, you pay that to the government as withholding tax. Now, the next type of dividend is called the stock dividend. Now, a stock dividend is paid in additional shares per existing shares owned. It simply means that, for example, let's use Globe again as an example. If Globe declares a 5% stock dividend and you have 100 shares, that means you will get 5% of 100 as additional shares as dividends. So 5% of 100 is 5 shares. So you get an additional 5 shares if Globe, for example, declares a 5% stock dividend. So it's as simple as that. Now, why do companies do this? Well, the main reason is they want to preserve cash. Of course, dividends are a way to reward investors for holding the stock, for holding the company's stock. So management wants to reward investors. But sometimes the company wants to preserve cash. So they can't declare a cash dividend because they want to preserve cash for their capex or what we call capital expenditures. So if they need the money to spend something on capex or capital expenditures, they need to preserve cash. So they instead declare a stock dividend because that allows them to preserve cash and at the same time still reward investors with additional shares in the company. Now, this should not change the company value because there is what we call a dilution if there are more shares issued to the investors, but at the same time, you have more shares. So even though the price adjusts when a stock dividend is declared, it adjusts proportionately to the amount of stock dividends that were declared. If, for example, again, if Globe declares a 5% stock dividend, then the price of Globe will also adjust accordingly. But that should not change theoretically your investment because even though the price adjusts lower, you still get more shares. So all in all, it shouldn't change. Now, the tax applies only up when you sell your shares. You don't get tax upon the receipt of the shares. It's only when you sell your shares that you are taxed. Now, next up is the property dividend. Now, this property dividend it's a lot less common. It's a rarity in the market to see property dividends. But of course, this has happened several times in the past already. But this is pretty much the least common type of dividend. Now, for the property dividend, these are paid in shares of a subsidiary of a company or in physical assets. The owners can keep the asset for the long term if they want to. And again, tax applies when you sell the assets or the shares of the subsidiary. That's the only time that you will pay taxes, but you don't pay any taxes upon the receipt of the property dividends. So just to give more color on the property dividends, a perfect example of this, for example, is Rockwell Land. Rockwell Land is a property dividend that was declared for Meralco shareholders. So it was not listed before, but for all Meralco shareholders, I think this was a long time ago, probably several years back already. So all Meralco shareholders received shares in Rockwell Land because this was a subsidiary of Meralco. So that's one example of a property dividend. Another more recent example will be the property dividends declared by Robinson's Land. This is APVI, or Altos Property Ventures Incorporated. So Robinson's Land declared property dividends, and the shareholders of Robinson's Land received shares in APVI, or Altos Property Ventures, as their dividends. So those are examples of property dividends. Next slide, please. So let's first define what dividend investing is. It is an income-oriented investing strategy. Of course, there are various types of income-oriented investing strategies. You can invest in preferred shares, you can invest in corporate bonds, you can invest in government securities. Anything that provides you a steady stream of income is an income-oriented investing strategy. And dividend investing is one type of an income-oriented investing strategy. Now, what are the advantages of dividend investing? Number one, it's a good starting point for beginners, because the main reason for that is you want to develop emotional maturity as an investor. And the way to do that is to realize the gains when you invest regardless in any security. And instead of a growth stock where you will probably realize the gains in a couple of years, because the goals of the returns of the growth stocks are actually much longer. So you realize gains much longer. But for dividend stocks, you can receive it within the year already. You can feel the gains already. So you can get your feet wet. Because dividend stocks, they pay dividends depending on the stock. They can either pay it annually, semi-annually, or sometimes some stocks like LTG pay 3 times a year. So it's a good starting point for beginners, because you'll be able to realize your gains pretty faster than investing in growth stocks. So it helps get your feet wet. And the other one is, well, this one is, I guess, is pretty obvious. It's predictable income. High dividend yielding stocks have predictable cash flows, predictable dividends. So that's another advantage of it. It's something that you can receive with much more certainty rather than just relying on price appreciation alone. And number 3 is it helps fight inflation. Dividend stocks in general tend to grow over time. So it's actually a very good way to help starve off inflation, especially with now inflation rising, commodity prices, oil prices are rising. So it's actually a perfect time to go dividend investing. And the next concept that we want to discuss is total return. Total return is simply the return that you get from price appreciation. Price appreciation simply meaning the stock you own is priced at 1 peso and now it goes up to 2 pesos. That's price appreciation. But the other part of the total return, which a lot of people forget, are the dividend income that you receive over time. So you have stock price appreciation and dividend income. You combine the two, you add the two, and that's what you call total return. And with dividend investing, you are trying to capture the dividend income, that other part of the total return. Most people just focus on price appreciation, but over the long term, you'd actually be surprised that a big chunk of the gains in the market will actually come from dividend income. So that's what total return measures. Next slide, please. So let's now go to the pros and cons of dividend investing. Let's go first to the pros. And number one, it's less volatile. Dividend stocks are less volatile because they have more stable operations. So we'll actually get into the factors that go into choosing the best dividend stocks later on. But for now, it's safe to say that they are a lot less volatile than growth stocks because their operations are a lot more stable. And next is they have a stable income stream. When you invest in dividend stocks, it's something that is predictable. And the next is it tends to perform well in a defensive market. Now, the reason for that is dividend stocks are considered safer haven stocks compared to growth stocks. Now, the reason for that is number one, they are less volatile. So, of course, in a crisis, for example, in a pandemic, in a recession, in a black swan event, you want to invest in stocks that have lower volatility and that have more stable operations. And those are dividend stocks. So that's why it performs a lot better than growth stocks in a defensive market or in a bear market. A perfect example of that would be during the pandemic. In 2020, it's the dividend stocks that actually outperform the market. So it really has a lot of benefits. Now the next one is companies are usually well established already in the industry. That's the nature of dividend stocks. The fact that they are able to give a big chunk of their earnings as dividends, that means they are already well established in the industry. They're usually market leaders. They have a big role in the industry. They have a strong foothold in the sector. And that's the reason why they are able to declare dividends because they are considered cash cows already. That's opposed to a growth stock where most of their earnings, it's not declared as dividends. It's reinvested back in the company because they have a lot more growth opportunities. Now, compared to companies that are more well established, there's less growth opportunities for these large established companies. So what do? Instead of reinvesting their earnings back into the company, they just pay it out as dividends. That's why dividend stocks are usually companies that are already well established in the industry. And the next one is there is less need for active investing. Now, this doesn't mean that you can be an active investor when you're dividend investing. I think you should still monitor your portfolio every now and then. But relatively, compared to our portfolio that is composed of growth stocks, there's less need for active investing in dividend stocks. Simply because of the previous bullet point. The companies are well established already. So there's a lot less risk when you're a market leader than an up and coming company. So there's a lot less risk. Your operations are more stable. That's why there's less need for monitoring compared to growth stocks, for example, which there's a lot more risk because they're probably launching new products, expanding to new markets, new geographies. So there's a lot more things that could go right or wrong in growth stocks. That's why you need less investing when you're investing in dividend stocks or companies that are well established already in the industry. Next, we go to the cons of dividend investing. So just to equalize the pros a bit. So the first disadvantage of dividend investing is you have less capital gains. Now you have less capital gains because price appreciation is really the realm of growth stocks. As mentioned a while ago, the earnings of the growth stocks are reinvested back into the company because they have a lot more growth opportunities. So when their project goes well, their expansion, for example, or a new project launch goes well, then that will lead to an increase in the stock price. As compared to dividend stocks, there are less growth opportunities. There are growth opportunities, but there are definitely less growth opportunities. So with less growth opportunities, you also have less price appreciation. That's why you rely most of the gains in dividend stocks through the dividends that you receive rather than price appreciation. So that's one, you have less capital gains in dividend stocks. And the second con is they tend to underperform in strong markets. So this goes hand in hand with, again, growth opportunities. We keep on going back to that because that is really the main difference between a dividend stock and a growth stock. So when you have growth opportunities, you tend to grow more than the market. And that is an example of a growth stock. But if you are well established already and you have less growth opportunities, then you won't grow as much. Therefore, in strong markets, dividend stocks tend to underperform. But again, remember that in a defensive market and in a bad market, dividend stocks tend to outperform or to perform better in the market. So those are two aspects of dividend stocks. And the third con would be they are vulnerable to dividend policy changes. Now, for minority shareholders such as us, this is something that is really out of our control. If the owners or the majority shareholders decide to have a change in the dividend policy, for example, if a real life example of this is PLDT, they pay 60% of their income as dividends, but they can decide 1 year that instead of paying 60% of their income as dividends, they will lower it to 20%. So that's something that's out of our control. And that is where we are vulnerable to dividend policy changes, because that's something that we can't do anything about. And the fourth one will be tax implications. As mentioned earlier, when you receive dividends, you pay a 10% dividend tax, as opposed to, for example, selling shares, you have a sales tax of 0.6% plus the other charges. So it's pretty small. But when you receive dividends, you pay a 10% withholding tax. So those are some of the tax implications with dividend investing. And the last one would be concentration risk. In dividend investing, the sectors are pretty much concentrated. A lot of the high dividend yielding stocks are in the power sector, utility sector, or the telecommunication sector. So it's concentrated in a few sectors. That's where you have concentration risk. Because unlike growth stocks, you can have exposure to the consumer staples, consumer discretionary services, the fintech. So you can have growth stocks in various industries. But for dividend stocks, these are only concentrated in a few sectors, and therefore you have concentration risk. Next slide, please. So we'll now go to the mistakes that we want to avoid in dividend investing. First one is failing to align your investment goals with your investment strategy. Now for this one, this actually doesn't just apply to dividend investing. It applies to investing in general. You have to know your risk tolerance. You have to know your investment horizon, and you have to know your liquidity requirements. Equity investors are usually aggressive investors already, but within that spectrum, there are various sub-levels. For example, if you are a more conservative equity investor, you might want to go with dividend stocks. But if you are the most aggressive type of equity investor, then you might want to go with growth stocks. So it really depends. And what's your time horizon? Growth stocks, probably before they become a large cap company, growth stocks could probably take several years before they achieve market leadership in their sector. So are you willing to wait that long? If not, then dividend stocks are probably better for you. And if you have liquidity requirements annually or semi-annually, that's also something to consider, whether you want to invest in a growth stock or dividend stock. Because for growth stocks, you can't expect any regular stable income stream from growth stocks, but you can expect that from dividend stocks. So you have to consider these things before you create your investment strategy, so that your investment goals are aligned with your investment strategy. And the second one, this is actually a common mistake for beginners, and I was guilty of this when I was just beginning to invest. It's not being able to reinvest the dividend income. Now, when you invest in dividend stocks, of course, you receive dividends, but that doesn't mean that once you receive it, you reinvest it. Most investors actually just leave it there. They just leave it in cash. Once they receive their dividends, they either spend it or they just leave it in cash. They fail to reinvest it. Now, reinvesting is very important because of the concept called compounding. Because in compounding, you let your earnings earn, and your earnings are the dividend income you receive. Instead of just letting it stay in cash, or instead of spending it, you reinvest it into the dividend stock so that you will it's not only that your capital will earn, your earnings or the dividend income will also earn from that. So it keeps on compounding and compounding. And that's the concept of compounding that we really want to take advantage of. So always remember that once you receive dividends, reinvest it. Whether you want to reinvest it in the same stock, it's up to you. But the important thing is reinvest the dividends that you receive. And the next one will be the lack of due diligence on the stock. Now, a lot of people probably rely on tips when it comes to investing. Like your friend says, okay, bilihin mo to because maganda tong stock. That's not really the way to invest, because that's gambling. That's not investing. And you don't want to gamble. You want to invest. That's why you have to do your homework. You have to do your due diligence on the stock. What's the company about? What are the prospects? What are the industry dynamic? Is it an oligopoly? Is it a perfectly competitive environment? It takes a lot of work, a lot of preparation in order to do in order to do your homework, in order to conduct due diligence. But it's really part of the process. You can never be a good investor if you don't do your homework. Simple things such as, what does the company do? What's their revenue growth or their earnings growth for the past couple of years? What are their plans for the future? Those are the things that you really have to consider when investing. So just don't rely on tips. You can listen to tips, but you have to do your own homework. And that, even though it's hard, even though it's tedious, that's what it takes to be a good investor. And the last mistake that we want to avoid is for us to think that the highest dividend yield is the best dividend stock. That's not always the case. Because one example of this, for example, you have a company that sells a piece of land for a huge amount. And then the company decides that the proceeds of this land sale will be declared as dividends. Now, can they sustain this kind of dividend? No, they can't, because they just sold an asset. It's not part of their core operations. They just sold their asset, and now we as shareholders are receiving dividends from that asset sale. But it doesn't mean that they have land to sell every year. They probably won't have another asset sale for the next several years. So that's a one-off dividend. So you have to always check, is this dividend just a one-off? Is it because of an asset sale? Maybe they can't sustain this kind of dividend anymore. So we have to check out the dividend payout ratio, the track record of the company, in order to determine whether they can sustain this kind of dividend or whether they have the track record of giving these levels of dividends. Next, we check the future prospects of the company. Again, the highest yielding company is not always the best. For example, you have stock A, which gives a dividend yield of about 5%. And you have stock B that yields only 4%. So on the surface, you might think that stock A is the better dividend stock because it has a higher dividend yield, but that's not necessarily the case, because you have to check its future prospects also. What if stock A is not growing anymore? The dividend yield is stuck at 5%, but stock B has a lot more room to grow. It has a lot more growth opportunities. So it may be 4% this year, but next year it could be 6. Then the next year it could be 7, it could be 8, because stock B has a lot more growth opportunities. So you always have to consider whether the company has growth prospects, because if it has growth prospects, then it has the ability to grow its dividend significantly over time. So you also have to consider that. And for these things, you can just check out the company's annual financial statements or quarterly financial statements to check out their dividend policy. So those are some of the mistakes that we want to avoid as beginners. Next slide, please. Next is choosing the best dividend stocks. Now, these are the factors that we want to consider in choosing the best dividend stocks. So number one, they must have strong and stable cash flows arising from either a solid business model or favorable industry dynamics. Now, we want a company to have strong and stable cash flows because that's where our dividend comes from. So if you have a strong and stable cash flows, then you can be assured that you will receive dividends and that it will grow over time. Next is strong credit standing. Equity shareholders are last in the priority of cash flows versus, for example, the debtors. So we must make sure that the company's debt is manageable. They don't have too much debt, because if they have too much debt, they will spend most of their resources paying off that debt. And there won't be enough money for investors anymore to be declared as dividends. So we must make sure that the company has manageable debt and they have a strong credit standing to make sure that there's enough earnings for us, that there's enough cash for us to be declared as dividends so that we can receive those dividends. Next is an established minimum dividend policy. Now, this is what I was talking about earlier, that the company has a dividend payout ratio. So that's their dividend policy. And it's important, again, you can find this in the annual financial statements or quarterly financial statements, their dividend policy, it's stated there. And it's important to have a minimum dividend policy because that's where you will know how much money you will get in terms of dividends. If a company says it could declare 100% of their income as dividends, that's a maximum, but there's no minimum stated. So they could decide 1 year that they could declare 0% or just 10% or 20% because they didn't state a minimum. They only stated a maximum, but they don't have to follow the maximum. They can go as low as 0, but what they have to follow is the minimum dividend policy. So that is what is most important. They must always have a minimum dividend policy. And you can ask your local brokers for that. I'm sure they know all of these things. So when you go in choosing the stocks, you can ask your brokers, you can take a look at the financial statements of the company, and you can find the minimum dividend policy there. If it doesn't have, then it's probably not a good dividend stock. The next is good governance standards. This one is simply points to corporate governance because there are cases where the owners avoid paying dividends by just upstreaming the cash via royalties, therefore bypassing the minority shareholders such as us. So we don't want that to happen. So we must make sure that there's good corporate governance for those dividend paying companies. Next is predictable CapEx. CapEx is simply capital expenditures. For those of you who don't know, capital expenditures are just the funds used by the company to either upgrade, maintain, or acquire physical assets such as building, property, equipment, or even technology. So that's what CapEx means, or capital expenditures. So you want this to be predictable. Now, you want this to be predictable so that you know how much dividends you will receive in the future, because the higher the CapEx, the less room for dividends that you will receive. So you want the capital expenditures of the company to be pretty much predictable so that you know how much dividends you will receive in the future. Next is low risk of fluctuations in revenues and costs. So this goes back to the strong and stable cash flows. We really want stability in dividend stocks, whether it be on the revenue side, on the cost side, on the earnings side. We want dividend stocks to be stable, to have stability, because that is the nature of dividend stocks. And that is also why, as I mentioned a while ago, dividend stocks are less volatile. That's also because their operations are less volatile. It goes hand in hand. Growth stocks are more volatile because their operations are more volatile. The fluctuations are larger when it comes to their revenues and earnings. For dividend stocks, the fluctuations on their revenues and earnings are much smaller. Therefore, the volatility on the stock price is also much smaller. It's also a lot lower. So this just goes to show that dividend stock, that's the main asset of dividend stock. It's that they are stable and reliable companies already. And I think those are the factors that we have to consider when choosing the best dividend stocks. Next slide, please. Here, we're just going to take a look at PLDT in relation to the factors that I mentioned in the previous slide. So first, does PLDT have strong and stable cash flows? Well, given the oligopolistic nature of the telco industry, they are one of the largest there. Their cash flows are pretty much protected, given that they are the largest broadband provider and the second largest mobile operator. So they have strong and stable cash flows that pretty much do not fluctuate. I mean, it does fluctuate, but compared to a growth stock, it's a lot more stable because they have a strong foothold in the telco industry. And next is strong credit standing. And yes, we can check that tick box for PLDT. They do have a strong credit standing. They enjoy a strong line of credit. Their gearing ratio is only 1.9 times. Oh, by the way, gearing ratio is simply how much debt the company has in relation to their capital. That's simply the gearing ratio. And we want it to be pretty much stable. And the gearing ratio of PLDT hasn't moved much for the past 10 years. So it pretty much shows that they are managing their debt well. Now, the next one is a minimum dividend policy. And PLDT has this. They have explicitly stated in their financial statements that they will pay 60% of their income as dividends. So that will give you a 5% dividend yield based on current prices. Next is good governance standards. There's no issue here on PLDT. They have very good corporate governance, very stable dividends, continuously growing over time. They have always had good standing relationships with their minority investors. So that's another check on that tick box. And next is predictable capex. And PLDT has also done this. They have been very transparent with their capex. They have elevated capex, or they do have elevated capex because they are expanding in the fixed broadband business, just like Globe and Converge, where they are going toe to toe in terms of the fixed broadband business. So they have elevated capex, but that's not really much of a problem because they have been transparent about this and they have communicated this well to the investors. So it's pretty much predictable because they have communicated this well to the investors. And the next one is low risk of fluctuations in revenues and costs. Again, because of the sheer size of PLDT, being the second largest mobile operator and being the largest fixed broadband provider in the country, there is very little risk of high fluctuations on their revenues and costs. And also another thing to point out is there's no price war going on with PLDT, Globe, and Converge on the fixed broadband side. They have pretty much converged already on their pricing, on the pricing of their products. So there are no issues there. That's why lately we have seen relatively low fluctuations on their revenues and costs. So PLDT, I think, checks all of these tick boxes, and it's definitely a good dividend stock, and it always has been a good dividend stock for the past decade already, given that they have maintained these 6 factors and they have maintained very good relationships with the minority shareholders. Next slide, please. So the key takeaways, this will actually be my last slide. So I just want to sum it all up. What are the key takeaways in this presentation? Number 1, dividend stocks are good for diversification. As mentioned a while ago, that dividend stocks tend to perform well when the market is bad, when there's a recession, when there's a black swan event, whether there's an economic crisis. They tend to perform well because they pay regular dividends regardless of what happens in the economy. They are well established, they have strong and stable cash flows, they have stable operations. Therefore, they are able to keep those dividends coming. And that's why they perform well in bad markets. And that's also the reason why dividend stocks are always good to have in your portfolio to smoothen out the volatility of your portfolio. If you're purely owning a growth stock portfolio, it will be very volatile. If you want less volatility on your portfolio, then add dividend stocks. because diversification is actually key to being a good investor. Next is looking at total shareholder return. Again, with dividend investing, we always want to capture the dividend income in that total shareholder return. If you recall, total return simply means the price appreciation plus the dividend income, and that's the total return. So don't forget about the dividend income. That's a big part of your long-term returns, especially if you're a long-term investor. So don't forget that part of the total return, the dividend income, because it is absolutely vital if you're going to invest in the market in the long term. And dividend stocks are the perfect proxy for that. And lastly, always conduct due diligence. Again, do your homework. The factors that I mentioned in the previous slide, it's a good starting point for you to do your fundamental analysis, to do your homework. It's a good starting point for you because by using those 6 factors, you will be able to determine already whether it's a good dividend stock or not. So again, it's tedious. It takes a lot of prep work, but that's what it takes to be a good investor. So always remember to conduct your due diligence. So that would actually be it. Thanks a lot, everyone, again for listening in, and I hope you learned a lot from my presentation.
Thank you very much, Carlos, for that insightful presentation. All right. So, okay, moving on. So, we have a short presentation about PSE's newest thematic indices. So, my colleague from the PSE's Market Data Department will talk about the PSE Midcap Index and the PSE Dividend Yield Index. So, let me introduce her. Our next resource speaker is a market data officer at the PSE. So their team is primarily responsible for all market data products of the exchange, and she particularly had an active participation in the development of the new thematic indices. So she graduated with a Bachelor of Science in Economics degree, specializing in development economics from the University of the Philippines. Let's all say good afternoon to my friend, Sarah Joy Mercado. Hi, Sarah.
Hi, John. Thank you for having me.
Of course. And very, very excited naman na makasama ka on screen.
Finally,
ang ganda ng ang ganda ng lighting mo dyan. So, tell us more about this mid-cap at saka dividend yield index. I know you have a full presentation about it, pero mahirap ba? Mahirap ba mag-roll out ng bagong index?
Alam mo, it takes a lot of work to make an index kasi syempre you have to consult then with the experts, ganyan, you have to do a lot of backtesting, you have to do a lot of benchmarking against other exchanges and stuff like that. Ayun, mahirap siya, pero ayun, we have new indices.
And all these efforts, why did we come up with the 2 thematic indices?
What for? Explaining that later.
All right. So, guys, you have here Ms. Sarah Mercado. We'll talk about the mid-cap and dividend yield index. Sarah, the floor is yours. Take it away.
Okay, thank you, John. Hang on, let me just share my slides. Okay, so good afternoon again. I am Sarah from the Market Data Department of the PSE. And the PSE recently launched 2 new indices, which I will be discussing today. These are the PSE Dividend Yield Index, or the PSE DIV, and the PSE Midcap Index. So before we begin, here is there. So here's a brief outline of how my discussion would go. I would first give a brief introduction to market indices, and then we will go into the features of each index after that. Okay, so let's start. So what is a market index? A market index is a basket of stocks which represents either the total market or a particular sector, and it is used to track market performance. And you can also use it to look into market trends. So currently, the PSE has these indices. So first is the PSEI, which is the benchmark index, the main index of the exchange, which is composed of the 30 largest and most active common stocks. We also have the 6 sector indices, so the financials, industrial, holding firms, property, services, and mining and oil sectors. The next index is the All Shares Index, which covers all of the common stocks that are listed on PSE's main board. And the ones that I'll be discussing today, the new ones, the thematic indices, which tracks the performance of companies with a particular investment theme. So first off, the dividend yield index, this is the one that focuses on companies that consistently give high yielding dividends. So the next one is the mid-cap index, which is designed to capture the performance of the mid-sized companies listed in the exchange. So how did we come up with these indices, as John asked earlier? So these were benchmarked against the existing indices of peer exchanges and index providers in terms of their listing history, free float, liquidity, and since they are thematic indices, according to the cash dividends declared and to market capitalization. And as well as the, don't forget the number of constituents. So why did we provide new indices? So aside from providing an additional tool to track market performance, we also want to feature non-index stocks. And new indices can also be used as a benchmark for new ETFs or investment funds. Pero hindi ka naman investment fund, ganyan. What's in it for you? So how is it relevant to an investor? So for one, you can use it to track the performance of your personal portfolio. So you can use it to look into how well the stocks that you personally picked are doing. And if you would like to expand your portfolio, you can also use it as an investing guide. Why? Because we consulted with the expert. We consulted with fund managers. We looked into the benchmarking against other exchanges. And again, I would need to reiterate that we are not giving investment advice, okay? Think of it more like us providing trading ideas. So let's start. The first index that I will be discussing is the PSE Divi, or the Dividend Yield Index. So how do you qualify for this index? First of all, your free float should be at least 15%. And in terms of liquidity, you have to be part of the top 25% in terms of median daily trade per month in 9 out of the 12 review period months. So this is the important part, the dividends. So you should have issued cash dividends for the past 3 consecutive years, okay? So lastly, you have to be listed for at least 12 months, but for the case of REITs, it could be 6 months, given that they satisfy the free float and the liquidity requirements, and of course that they give a clear dividend policy, as also stated by Carlos earlier. So the PSE Divi Index is composed of the top 20 companies with the largest 3-year average dividend yield that passed the free float and the liquidity requirements. So I know this slide looks a little bit intimidating, but I guess it should be pointed out that one of the features of this index is that instead of using the normal free float market capitalization, here we adjust it, we multiply it by the dividend yield of the company. So we use a dividend yield adjusted free float market capitalization. Another feature to note with this index is the capping factor. What is capping? Yes, I know this is new. And why is capping done? So index weight capping for the dividend index, at the start of each recomposition, the weights of the constituents are redistributed so that the weight of each constituent is no more than 10%. So why do we do this? So this is used to reduce the concentration risk of price movements from large companies, so it won't significantly affect the movement of the index. So for example, here, companies A, B, and C, if you would notice, the weights are higher than 10%. And then please also note the weights of the other constituents. After capping, you would notice that companies A, B, C, and even D are capped at 10%. So none of them are higher than 10%. So what happened to the yung sobrang weights? So they got redistributed to the other constituents. Parang mas equal, mababalance out yung large cap companies. Okay, so here are the current constituents of the PSE Divi as of the latest recomposition. And here they are arranged according to 3-year average dividend yield. So I know that you may already be familiar. Some of the companies that give out high dividends regularly are not here, not on this list. This is probably because they did not pass the free float and the liquidity requirements. So it's important to note that it's not just that they have high dividend yields. They also have to be, tradable. They have to be stable, and they have been already screened. So here is how the PSE Divi performed since in 2010 compared to the PSEI. Here we are comparing the TRI, or the total return index counterpart of the indices. Why? As Carlos also explained earlier, the total return looks into both the price performance as well as dividend income. So as you can see, for the YTD performance, the PSE Divi did better than the PSEI so far. Okay. So here we compare the top 10 constituents of the PSE Divi compared to the top 10 constituents of currently existing local dividend-based funds, at least some of them, not all of them. And if you would notice here, a lot of the constituents of the local dividend-based funds include PSEI stocks. This is probably because, one, because of the lack of a current benchmark, and two, perhaps they would try to match the performance of the PSEI or do better than the PSEI, which is why a lot of these stocks are PSEI constituents. However, we should note that some of the constituents of the PSEI do not have high dividend yields. Like for example, here they are below 2%, below 1% even. So that's what we did. We checked out the dividend yields of the other companies so that we could also highlight their performance. So now we move on to the mid-cap index. So how do we qualify for the mid-cap index? First, your free float should be at least 15%. In terms of liquidity, this is a little bit higher than the dividend yield index. So you have to be in the top 35% in terms of median daily trade per month in 9 out of the 12 review months. So for market cap, this is the important part. You have to be in the top 95% of the cumulative MCAP of the eligible companies. So for listing history, the company should be listed for at least 12 months. So the PSE Midcap Index is composed of the 20 largest companies based on full market capitalization, excluding the constituents of the PSEI. So like the PSEI, we also use free float market capitalization in its computation. So here are the current constituents of the PSE Midcap as of the latest recomposition. And here they are ranked according to market capitalization. Okay. So here is a comparison of how the PSE Midcap Index did compare to the PSEI as well as to the MSCI PH Small Cap Index. It's important to note that we included the MSCI PH Small Cap Index because, for one, the members of the PSEI and the members of the PSE Mid Cap Index are mutually exclusive. So they do not have overlaps in terms of their constituents. While the MSCI PH Small Cap Index, this is the closest existing index that we could compare this to. So if you would notice here, the returns, the YTD returns, PSE Midcap did better than the PSEI and the MSCI PH Small Cap Index. So here are the top 10 constituents of the PSE Midcap Index compared to that of the MSCI PH Small Cap Index. Oh, of the Midcap Index, sorry. And it's important to note in this slide, I guess, that a lot of the members of the MSCI PH Small Cap Index contain PSEI constituents. And as I mentioned earlier, we would like to highlight the non-PSEI stocks. So there. So to summarize my the new indices compared to the PSEI, in terms of free float, they are all you have to be at least 15%, but this would be raised to 20% effective end December 2022. In terms of review, they would be conducted every February and August of each year. So in terms of listing history, for PSEI, it's 12 months with early inclusion. For the DV, it's 12 months and 6 months per REITs, while for the Midcap Index, it's 12 months. In terms of liquidity for PSEI and PSE DV, it's 25%, while for the midcap, it's higher, it's 35%. So for the PSEI and for the midcap index, the final selection is based on market capitalization, while of course for the dividend yield index, it's based on the 3-year average dividend yield, cash dividend yields. And for the DV and the mid-cap, the constituents is 20, while for the PSEI, there are 30 companies. And for weight calculation, for the PSEI and the mid-cap index, we use free float market capitalization, while for the DV, we use dividend yield adjusted free float market capitalization. And lastly, we use capping only for the dividend yield index because of how wide the market caps may be. So for more information on these new thematic indices, you may check out the PSE website. Here is a working QR code. You can download the fact sheets under the thematic indices tab in the PSE website. And if you would like to see the index compositions of both the DV and the midcap, you can also find it in the PSE website, but on a different tab. It's under the market information tab. You have to get to the indices composition part. There's a drop down here. Just select the PSE DV and the PSE midcap. So here you can see the 20 constituents, their symbols, their last traded dates, last traded prices, and their outstanding shares. So for more information, if you would need to request data related to these new indices or any data requests, you may contact us, the Market Data Department. You may send an email at market.data@pse.com.ph. So before we end this presentation, again, a recap. The new thematic indices, so the PSE Dividend Yield Index and the PSE Midcap Index. Dividend Yield Index highlights the companies with highest dividend yields and provide consistent cash dividend payments. And as mentioned earlier, you also earn both from price appreciation and dividend income. So you may want to consider this as well for your portfolio since the constituents were already screened for liquidity and float. So for the midcap index, these are mid-sized companies. So that means there's still a lot of potential for growth, and these are as good as the current PSEI members. It just so happens that they're smaller, but they are also liquid and they also passed the free float requirements. Thank you again for listening to my introduction of the indices. Okay, back to you, John.
Wow, thank you, Sarah, for that very informative presentation. But before we end this session, we would like to ask our speakers for some key takeaways or parting words. Ladies first. So, si Sarah?
Key takeaways. Okay, so you already know that these indices exist, the PSE Divi and the PSE Midcap. You can go check them out. You can go check out the constituents. You might want to consider them in your portfolios, and contact us if you have any questions regarding, or if you have any data requests. That's it.
Thank you, Sarah. And now let's hear Carlos.
Yeah, so just to summarize the key takeaways that I've mentioned in my last slide, always do diversification by investing also in growth stocks and dividend stocks, and conducting due diligence, and of course also always considering total shareholder return. So again, just like what Sarah said, if you want to ask us anything, if you want to contact us, just go to our Atram website at www.atram.com.ph. Just click on contact us, and we would be more than happy to be of assistance. Thank you again, everyone.
Thank you, Carlos, and thank you, Sarah. How about we give our speakers a virtual round of applause? Before we end this webinar, I'd also like to share with everyone our contact info. If you need to get in touch with us, you may call the PSE at 632-887-64888 or email info@pse.com.ph. Visit our website, www.pse.com.ph for corporate information. For disclosures, just head to edge.pse.com.ph. And for investing materials, visit the PSE Academy website. A new website we will be rolling out very, very soon. I'm so excited for this one. Napakaganda ng bagong PSE Academy website. Follow us on social media. We are very active in social media. Please like and share our official social media accounts for the latest updates about the market and our investor education initiatives. We are on Facebook, Instagram, Twitter, LinkedIn. We're also on TikTok, and we're also on YouTube. So please subscribe to our YouTube channel, and while you're at it, hit the bell icon. Help us reach 50,000 subscribers by the end of this year. All the video materials, learning materials are available at the YouTube channel. And I'd also like to remind everyone to download the PSE apps. We have the PSE Edge for the latest disclosures right at your fingertips. And for the PSE Easy mobile app naman, for whenever there's an IPO or FOO, you can subscribe online through the PSE Easy mobile app. So thank you for spending your Friday afternoon with us. Stay tuned to our Facebook page for updates on sa aming susunod na webinar. Very exciting ang topic. So yeah, announce na namin yan next week. So before I end today, I'll leave you all with this quote from another Carlos Slim Helu. He said that courage taught me no matter how bad the crisis gets, any sound investment will eventually pay off. Think about that, ladies and gentlemen. Again, this is your host, John Garcia. I'll see you all again next time. Happy weekend.